Toby. Welcome to our show.
Thank you. I am the income generation.
And so am I.
I think we're all the income, so I love the idea of the show.
Great. Well, good to have you here today.
Thank you.
Tell us about your company, the next big thing, equities research.
Well, we've always focused on transformational change. And so, simply speaking, it's the world's greatest wealth creator. It's also the world's greatest wealth destructor. And I think, we've seen both sides of that. As it applies to income generation, to actually earning income, we've looked and worked in a lot of alternative income generators. So, for instance, master limited partnerships have been a very popular investment. Real estate investment trusts are maybe a little bit different than the average bear, and then bonds, and just sort of corporate bonds, but not AAA, not junk, but sort of the mid-level, a 1% default rate, and I think we can stock pick, right? So if you combine that, my message is that many times people will get in, for instance, to a master limited partnership, and a broker will call them and say, look, you're going to get a 9% yield, and you don't have to pay taxes on it, or 85% tax free, no risk whatsoever. And yet, there's many people sitting here today that own a master limited partnership that, let's say they paid $40 for that per unit, and that unit's selling for $20 today. I mean, there's some
many like that.
Or many like that. I mean, their average price are down about 35-40%. And that's not coming back the way that it did, because they were in a transformational event, this whole fracking world in the United States, and people sort of got visions of sugar plums in their head and said, my gosh, we're going to be going from 9 million barrels a day to 20 million barrels in the United States, and we better build every pipeline we possibly can. Well, guess what? It's a cyclical business. The faster something transforms, the faster something saturates. So whether it would be, fiber optics in the late 1990s or fracking oil coming out from 1 million barrels a day to 7 million barrels a day, at some point in time, you've hit a saturation. So my point is that if you get in master limited partnerships, for instance, or you got in a real estate investment trust that you really don't understand, there is principal risk involved there. And I think if anybody tells you other than that they're lying to you, or they don't know enough to be an advisor.
You said a few minutes ago that transformational change is the biggest creator or biggest destroyer of wealth. Can you give me an example of each one, or maybe one where it was a big creator and then subsequently a big destroyer?
Well, let's look at my fair friend Harold Hamm from Continental Resources. So he had this idea that you could drill sideways into rock, because shale is just rock, right? And somehow the hydrocarbons, oil, and the gas would come out, and people said he was crazy. So he leased a bunch of land up in Continental Resources, the ticker symbol is CLR, right? And lo and behold, he was right. So oil prices went up, his inventory went up, his reserves went up, and so he was worth, at one point, $7.5 billion, and shareholders had about a 50-to-1 return in their stocks. It really wasn't an income stock, it was a growth stock. But again, that same stock today is down 65%. People who bought it at the high are not even getting a dividend. And my point is, almost by definition, anything that rises quickly, by definition, is getting to a saturation. So it could be something like a Blockbuster. If you think back to that company, and you could actually go to a video store and rent it. How great is that? They have 5,500 stores around there. Then this thing called Netflix happened. So they were the disruptor, and Blockbuster went like this, and people, and then Netflix came, and now Netflix, the stock is up 31,000% if you take it from the bottom, and Blockbuster's out of business. I mean, it happens, that cycle happens time and time again. In income, in bonds, because I'm a big fan, again, of sort of this corporate mid-level bonds, 1% default rates. But again, you got to look at the company. So the person who bought the bonds in Continental Resources, for instance, those bonds are selling at 70 cents on the dollar. People who bought in a quote-unquote safe energy companies have bonds that are down, 20%, and they're never going to get that money back. I mean, unless the world changes. So I guess my big message here is, if you're not buying sort of straight ahead bonds for income, you can't buy and forget. There is no buy and hold forever in alternative ways of getting higher rates of income. And let's face it, when you're getting 25 or a quarter% out of your money market account, or you're buying a 10-year CD at the bank and getting 1%, people need more income.
So it's not like the George Foreman grill. It's not set it and forget it. Is that what you're trying to tell me?
And you can get burned.
Our viewers want to hear set it and forget. They want it to be
on
simple.
The George Foreman grill too, by the way. But that's a great example.
You get burnt on any grill. That's the problem.
The company that started that, that owned the rights to that, did fabulously well. until people actually use the George Foreman grill to a certain point, and everyone who was crazy enough to operate that grill, bought it, and the same thing, and they went exactly that way.
I don't know about you. Maybe it's that bad experience. Mine worked quite fine, I must admit. But
for grilled cheese sandwiches, come on, man. I'm not for grilling anything. Yeah.
Let me ask you though.
Yeah.
You talk a lot about investments that give cash flow of 10 to 12%.
Right.
And of course, as we all know, and as our viewers know, that cash flow is not necessarily the same as income, which is obviously my main focus.
Sure.
So can you tell our viewers a bit about the difference?
Well, again, it's a great example. So if I'm a master limited partnership or real estate investment trust, I'm getting cash flow in, I get rents, or I get whatever, I'm selling sand, whatever it is, and by law they have to distribute 90% of whatever that cash after expenses is. So that's cash flow. But many times, to maintain their dividend, their distribution, they will also borrow money, or they will do other things to enhance that. And that's the number one red warning signal. So anything we look at in the alternative space, whether it's, and we happen to like medical centers. For instance, Omega Healthcare, OHI, we've owned that for years. Income has gone up every year for 12 years. I think we bought the stock as an income stock at $8, maybe $5. It's now a $35 stock. So there are things such as income and growth if you get the right trend. But they've never distributed more than the income they've got in rents. They haven't done sort of these fake accounting games. And so again, if you're going to stay out of the straight ahead bond business and get a little bit outside of it, you can't just, your advisor, whoever you're working with, you can't just say, well, gosh, they distributed 9.1%. That's their dividend. Well, where did that dividend come from? So you want to have 120% coverage of whatever you're paying out, so you're not paying out, or there's 80%, you're paying out 80% of what you're earning. Some of these companies will be, earning a $9 dividend, and they're paying a $10 dividend. Well, where did that other buck came from? It comes from refinancing, it comes from lending, blah, blah, blah. And that all looks great. It's like Warren Buffett says, it's only when the tide goes out you find out who's swimming naked. And the company that's paying a dividend that they can't support from their own operations is swimming naked. And when that happens, you wake up one day and it's on the news, and that stock, the company's down 25, 30%. It happens every year. And the people who said, I just wanted to buy this and, and just keep clipping coupons, if you're getting above, way above what normal treasury bills are paying, by definition, you're taking on more risk. We try to mitigate that risk by following trends.
But speaking of treasury bills, it sounds like what you're saying is that the corporate America cannot do what the U.S. government can. It cannot keep incurring interest on debt that it can't pay from tax revenue.
Correct.
So with that thought, we're going to take a break. And when we come back, we're going to ask Toby some important questions, some direct questions. Specifically, you're going to learn what industries he's recommending right now. We'll be right back. This is fun. This is great. 3, 2, 1. But I'd like to take a few seconds and tell you why I decided to write the book entitled Return on Principal. Basically, it all boils down to this. Let's face it, you deserve to live a happy retirement. It's as simple as that. But for many, the subject of money, finance, and math is complicated. Here's a fun fact. Many Americans claim that they'd much rather clean a toilet than calculate a tip in a restaurant. Thank you, I guess. But it doesn't have to be that complicated. Using the 7 core values I outline in my book, you too will be able to build a life based upon the right core principles. Cut. Return on Principal isn't just a book about financial investing, it's about investing in your life. I know for a fact that you're going to love it. Okay, now it's just getting a little weird here. Welcome back. We're here with my good friend, Tobin Smith. He's talking about transformational change.
Thank you.
You talked right before the break about watching out, being careful and cautious of investments that promise cash flow of 10 to 12%. Because sometimes these companies can't really afford to pay that much out. So there's a difference between cash flow and income. Yeah. Can you tell our viewers for just a moment what percentage or what range of percentages you can reasonably expect in income-generating investment vehicles?
Well, if you just stay at this, so there's this idea called a preferred bond or a preferred stock that basically gets all the income that gets paid to them first, and then if there's anything left goes to the next level, right? So preferred. So Apple stock, for instance, I mean, we've done wonderfully owning Apple, and we understand that business very well. My old research firm, ChangeWave Research, we were one of the first people to buy that stock, right? When they started selling the bonds weren't paying very much. I mean, their bonds were paying a 2% yield, but there's still preferred shares out there that you can buy. And if you take the dividend from Apple plus the preferred and then this appreciation, that's been a wonderful combination. The reverse of that is you could also have bought BlackBerry, in other words, a descending company, right?
Right.
I just was on a plane recently, and there was like one guy with his BlackBerry there, and he
right.
just looked like a dinosaur, like.
And he had his iPhone in his jacket pocket as a spare, right? Just in case.
So, but look at BlackBerry had preferred bonds, preferred shares, et cetera. They haven't paid an interest payment on those, et cetera, et cetera. The stock obviously has dropped, 90%. There's business risk, and then there's interest rate risk, and those are two separate things. And so, again, if you're going to step outside of the, safe and sane treasuries and so on and so forth, then you're going to have to look at some business risk. Also, defense companies, for instance, now. I mean, with what's going on in the world today, obviously their revenues are going to be larger, and they have some pretty attractive, bonds. I don't like the convertible stuff. Convertible stuff, it seems to me, their income.
More complicated.
It's more complicated,
It's a hybrid.
and blah blah blah. I mean, if you want to buy the stock, buy the stock. You want to buy the bond, buy the bond, right?
I agree.
But Lockheed Martin's got some decent paying yield, and I know you're a big bond guy, but we certainly like to match these durations. The great thing about a bond, as long as you hold it to maturity for a great company, you're going to get your money back.
Of course.
And so we're looking at ascending industries, certainly the cloud, for instance, cloud computing, everything involved in that. Well, there's some companies that own Equinox, is for instance a company that owns a real estate trust. It is a real estate trust that owns data centers. And they have preferred equity that pays, a 6-7% yield. The stock itself has gone up, 800, 900%. So if you had sort of 90% in that bond preferred, and you had 10% in the stock as your little equity kicker, then all of a sudden, we have people who've doubled or tripled their money in Equinox just on their 10% piece, and the yield has continued. So now you're growing, your portfolio and getting income.
So realistically then, what percentage dividend rate would you tell your clients that they can expect in investments like preferreds, for example?
Yeah, these are 5 to 6.5%, 7%, for the corporate mid-sized companies. If you're looking at REITs, real estate investment REITs, obviously as interest rates go up here, REITs start to lose value because they're competing with the no risk cost of funds, right? But I think as we get down the road, I think we're getting no more than a 2% federal funds rate for a variety of reasons. And according to the fact that the Fed has said the same thing, right? So that means the 10 years are going to price off of that. And now I'm going to be comfortable in buying REITs again. And I love medical REITs, all the medical REITs, Ventus, medical properties, because they have built-in escalators in their rents. They participate, some of them participate in the actual businesses. They get overages.
So it gives it less interest rate risk.
It's less interest rate risk, and those rates have continually gone up. And obviously 10,000 boomers a day are turning 65, and you consume about 70% of all your health care, from age 65 and on. And so, that's a growth industry that is going to grow no matter what.
So today, realistically speaking, somewhere up to 7% is
Yeah.
what people can expect through interest in dividend-bearing investments. If it's over 7%, then you'd say be a little cautious.
Well, if it's
correct?
over 7%, then there's a reason why it's over 7%. In other words, and even if the company earns $1 and pays out 80 cents, but let's say, for instance, it has interest rate risk, they'll continue to make that payment. You'll get your 7% or 8% or 9% payment, but the value, the principal of that REIT or some of those MLPs, et cetera, is going to go down in value. And it's not like there's, it could go down in value for a very long time. I mean, you're taking principal risk and interest rate risk. That seems like a bad combination.
Which is right, exactly. It's a double whammy.
It is a double whammy.
So now, the tough question.
Yes, sir.
Okay, I told you I wanted you here because I respect you, I love you dearly, but now you have to tell our viewers, what sectors today would you recommend that people consider in this realm of investing?
Look, first, I love the medical space. So any part of the healthcare space makes sense right now as long as you're not overpaying. And United Healthcare, for instance, has preferred. They have bonds as well as their equity that pays a nice dividend. United Healthcare said they're going to stop offering Obamacare, which to me is a great idea for a variety of reasons. Starting with they're losing money at it. And so the
we don't have enough time left on the show to talk about Obamacare.
So the stock came back a little bit, so I think they're buy. I like Molina Healthcare. So they're running the Medicaid plans. They're going to continue to do that more and more because the states won't run that. They don't. There's not a dividend paying, but it also got pulled back here. And then, you know, in the big picture of where healthcare is, we liked Pfizer. They just recently said they're going to merge. They're going to go. Can you blame them? Can you blame them? They're going to go to Ireland and they're going to get a 12% tax rate where they get 35 here in the United States.
Well,
wouldn't you?
They should be patriotic and they should pay their fair share.
They absolutely should. But you know what? Every one of their competitors aren't. And I believe in the free market and free enterprise. If all your competitors wake up in the morning and have a 30% advantage over your profit margin simply because they moved their office to Ireland.
And let's not forget, their fiduciary responsibility is to whom?
Exactly right. To the shareholders. It's not to
which is to maximize after-tax profits.
Right. It drives me nuts, and it's amazing that both the Democrats and Republicans couldn't come together on this issue.
Yeah.
It just is. But
common sense, you'd think.
But those ones, all that sort of is basically happened. And I think this Pfizer thing will be the final death knell. It's like in Canada, Bell Canada, which we owned for a long time, decided they wanted to become what's known as a royalty trust. And the Canadian government said, all right, no mas. And I think Pfizer, this is going to be the last, inversion because it's a big company. This is a 120 billion when you put it all together, and it's lost to American taxpayers.
By the way, I don't think they say no mas in Canada. I'm pretty sure it would be the French equivalent of no mas. I'm not sure what that is.
Yeah, something, yeah.
Well, I can't believe time flies when you're having fun, and we're out of time. And I wish I could have you here for the whole show. But since you and I see so eye to eye, I like to take a vacation every once in a while. Will you be my replacement host when I need to take a week off? Always.
I'm the professional guest host, by the way. That's what I do. I don't want to really do that all the time, but it's fun to guest host because I mess up. It's only, I'm only a guest.
You're only a guest.
It was your fault.
That's right. Okay, well, you heard it right here on this episode. When I'm on vacation, you'll see my good friend Tobin Smith here in my place.
You live in Florida half the year. That's vacation right there. I don't even know what you know.
Don't talk about that. All right, well, that's it. Don't go anywhere. We'll be right back with a lot of important tips of how to protect and maximize your income as an investor. Be right back.